gentlemen, it is indeed a great privilege and a pleasure, hopefully for all of us, to introduce our keynote speaker, who just arrived in the nick of time, just this morning. His CV is so long and so full of illustrious positions that it would take all morning to read. So I will just restrict myself maybe to a few key points. Sir Howard Davies was, or is the chairman of National Westminster, as you know, bank. As you know, Royal Bank of Scotland was renamed National Westminster, and he's the chairman. He's also a former director of London School of Economics. I mention these two things because both of them are close to my heart, and I would also like to say he was a consultant at McKinsey. Some of you know I was a partner at Booz Allen, and therefore I have to mention that. But he was the first founding chairman of the Financial Services Authority in the UK. He's chairman of the advisory council of the Chinese regulatory authorities, and so he has a very illustrious career, as he said, in banking, in regulations, and in UK government. He was an advisor to the Secretary of the Treasury. He was a chairman of the Airport Commission, and he has innumerable activities on that front, and he was, for that he was knighted. So it is really a privilege to have you here, Sir Howard. Thank you very much for coming. I know it's a long flight here, and it's certainly warmer than in the UK, so that changes. Please join me in giving a very warm welcome to Sir Howard Davies, who will deliver the keynote address.
Thank you. Well, Gordian, you're wrong about the weather, because the weather in London is almost exactly the same for once as the weather here. It was hot and muggy. I mean, it's fashionable these days to talk about deglobalization, but in weather terms, there is perfect globalization, I can tell you, between London and Bangkok. It's exactly the same. I've been asked to do something quite challenging this morning, because I was asked to talk about the recent turmoil in banking markets in North America and in Europe, of course, but also to talk about some of these longer-term challenges to banks coming out of neobanks, fintech, AI, etc. So the only hope I've got is that I'm going to talk quickly and using a certain amount of shorthand, because otherwise I've got no chance. But I'm conscious that everything I say will be pretty headline nature, and I'm sure that in the discussions afterwards we can get into somewhat more detail. We have been moving in the banking world in the Northern Hemisphere through a pretty turbulent period, and that's true both in the US and in the EU. In the US, I'm not going to talk in great detail because I've got Barney Frank here, who of course knows more about the US banking system than most people have ever known, and so I'm sure he will give us some detail. But let me just say a little bit about what has gone on there and the implications, particularly for the rest of us. The US collapses began, of course, with Silicon Valley Bank. Curiously enough, I knew the bank because NatWest had an office in its building in San Francisco. Actually, we were dealing with relationships with various fintech companies over there, and we were there. And I met the chairman about 3 years ago, who told me very politely that he was the future of banking, aligned with the clients, focused on a particular sector in, of course, a fast-growing economy, and that it was nice to meet me, but I was a dinosaur and reflecting the old business model, which would no longer work. Now, the future of banking turned out in that case to be bankruptcy, and the Silicon Valley Bank and the others together were failures on the scale of 2008. I mean, this shows the total balance sheet size of the banks that failed this year and what happened in 2008-9. Now, why did this happen? Well, I can't give a full answer to that, and probably we've only got the first draft of history so far. One, of course, is that there are still rather a lot of banks in the United States. There are 4,200 banks in the United States versus 311 in the UK and 220 in France. But clearly there were issues involved in the supervision. And the Fed reviewed its own the Fed produced its own review of the supervision, particularly of Silicon Valley. They, of course, blamed the bank, which must be right, including the board, whose risk management was clearly deficient. But they also blamed their own supervision, saying that supervisors failed to take forceful enough action. They didn't appreciate the vulnerabilities of the bank's business model. Now, this is interesting, and no doubt there will be changes in the way the Fed operates in the future, but I guess for the rest of us, it's more important to see what lessons there might be for supervision generally. And how far is this relevant to Europe or indeed to Asia? Well, you may say in a direct sense, quite little, because the particular issue in SVB of an interest rate mismatch is not one that applies in the UK, certainly, or in the rest of Europe. We do have the supervisors do stress test for interest rate risk in the banking book, for example, which is not typically the case in the US. We have capital add-ons for interest rate risk in Pillar 2 in the UK. There isn't such a thing in the US. So in some ways, you may say this is a particular US issue, but it has reignited the regulatory debate. There are those, particularly in the academic world, as some of you will know, who are always arguing for more capital and more liquidity, and they've been emboldened further. But there are, I think, likely to be some implications. Not, I think, because there are other European banks in a similar state. There was some extremely unhelpful commentary from Hank Paulson in the Financial Times suggesting that there aren't any problems elsewhere in the US, but there'll be a lot of focus on Europe, where financial institutions aren't as strong or as well capitalized as they are here. This is a very, very peculiar observation, because if you look at, for example, liquidity, if you look at the liquidity coverage ratio of US banks versus European banks, it is radically different in precisely the opposite sense. But I think this is not particularly helpful to have people saying, oh, there are problems elsewhere. Investors have not taken that view, and investors have looked through what has gone on in the US and compared it elsewhere, and the regional bank index in the US has dropped sharply in relation to the European bank index. So investors have looked through all of that. So what will be the implications if these are somewhat red herrings, I think, the liquidity point particularly? Well, in the US, of course, there's one rather peculiar feature, which is that JP Morgan now seems to come regularly to the rescue. And this takes one back to the days before the Federal Reserve was founded in 1913. Because in the absence of a central bank in the US, and the US didn't have a central bank until 1913, well, they had two previous attempts to have a central bank which didn't succeed. And we've now come back to a position where JP Morgan is in some ways acting as a kind of rescuer of last resort. And what we've therefore seen is that the share of deposits by JP Morgan has got higher and higher. But what about the regulatory consequences elsewhere? Well, it's pretty clear that in a number of countries, the deposit protection limits and the ways in which deposit protection are funded are now under review. That's certainly true in the UK, and it's certainly true in the European Union, because what happened in the US, the prospect of a lot of small businesses, particularly rapidly growing high-tech businesses, being unable to access their money for some considerable period if the bank failed, was clearly one that was not politically acceptable in the US, and I doubt if it would be in many other countries as well. So it seems quite likely that there will be some changes to deposit protection arrangements, and that could be somewhat costly for the larger banks. But what we can see is that the outflows from these US banks were very rapid over a very short period of time. And if you look at the assumptions regulators make at the moment about the speed with which deposits could flow out of your bank, they are out of date. And I would have to acknowledge that's true in our case, and it's probably true in yours. So I would expect, and the Basel Committee is already beginning to look at this, I would expect that we will have some tightening on liquidity. I think on capital, the Fed is likely to be somewhat tougher on Basel 3.1 than it was going to be. Now, I focused a bit on the US, but of course there was another big problem, and that was with Credit Suisse. The Credit Suisse failure, though, was a much more slow-motion car crash. Credit Suisse was in a place where no one else was, and where no one in this room would wish to be, with very vulnerable deposits and a very low return on equity. And so this was a bank whose business model was, in my view, fundamentally unviable. And it was therefore likely at some point to fail. There is an interesting question, which is now extensively debated in Europe, as to whether the Swiss regulator should have intervened earlier. I've got my own view on that. But undoubtedly, this was a different type of issue, even though the deposit outflow did accelerate in the last quarter of last year. And the Swiss method of resolving Credit Suisse, or knocking it into UBS, upturned the normal creditor hierarchy. And that created significant disruption in the AT1 market in Europe for a while. But interestingly, the Bank of England and the European Central Bank intervened very quickly to say that they would not do such a thing, that they would not invert the creditor hierarchy. And in fact, as a result, the market has stabilized really quite quickly. We made a significant AT1 issue last week at very fine margins, and the disruption in that market now does, outside Switzerland, appear to have disappeared. In Switzerland, of course, there'll be litigation on this topic from now till the end of time. There is more concern, however, about the implications for the recovery and resolution regimes. The Swiss finance secretary said, "I've come to the conclusion that a globally active, systemically important bank cannot be wound up according to the too big to fail plan." That is a pretty fundamental statement. And all of us in this room who are significant banks will have gone through the agonies of producing a recovery plan and a resolution plan. In fact, I think the Swiss made a choice to resolve Credit Suisse in the way they did by knocking it into UBS. It could have been done in a different way. And it's very unhelpful, I think, that the whole resolution regime should have been thrown into doubt. And the regulators, I think, are now trying to reassert the viability of recovery and resolution, because it really is quite a fundamental part of the global regulatory architecture. And unless we can restore the credibility in that, then I think we do have a problem, because this is rather an important building block of international regulation, which has been thrown into doubt by the way in which the Credit Suisse problem was dealt with. So my view is that there are some implications of what's gone on from the US and Switzerland. They are still not totally clear how they will be resolved. Basel is looking at it. I think we can expect tougher liquidity rules, and I think we can expect some overhaul of the resolution of recovery, and I think we can expect some changes to deposit protection. None of these absolutely fundamental, but all in some way costly. Now, looking at the slightly bigger and longer-term picture, what we can see is that if we take the evolution of the global banking system over the period since 2006, we see some pretty striking things, which is that on a market capitalization basis, US and particularly Canadian banks, I mean, the unsung heroes of the last 15 years have been the Canadian banks, whose market capitalization has increased absolutely dramatically. As you can see, the market cap of European banks has fallen during that period. Asian banks about flat, but it's North American banks and particularly Canadian banks who have done extremely well during this period. On the asset basis, well, Asian banks' asset growth has been dramatic, but the investors don't seem hugely impressed by that because the market cap has not responded to the growth in assets. So there are some interesting questions for us in Europe and in Asia to answer as to why it is that growth is not being reflected in the market appreciation of the value of these franchises. If you look at the league tables on big banks, well, the Asian banks have grown. Sadly, going back to December 2008, my bank was the largest bank in the world, and we chose to be the largest bank in the world at precisely the worst moment to be such a thing, because it was the moment before the major collapse. Asian banks are dominating, and on the brand values of banks, which is a calculation that the Banker magazine produces, the Chinese banks and US banks are the ones whose brand value appears to be growing and appears to be very robust. Before anybody in the room decides to congratulate themselves on this, I should point out that in 2022, one bank grew its brand value by 148%. It was trumpeted in the Banker magazine as the fastest growing bank in the world in terms of its reputation and its brand, and that was Silicon Valley Bank. But at the bottom are the European banks, where on average they're at about 0.7 book. The Asian banks are at 1.2 book, and the Canadians are at the top of this league. So Asian banks doing somewhat better with investors, but not dramatically so. So at the end of this period of turbulence, we're left kind of where we were, with banks undervalued according to investors, with the price to book low, even though, according to the ECB, we've now come out of this crisis. This is the ECB's overall stress indicator, which peaked earlier this year, but has now gone down into, as it were, safe territory, according to them. And there are a whole series of other challenges which, over a longer period, are threatening the business models of the banks for which we work. Obviously, the neobanks and the fintechs, there's blockchain and cryptocurrencies. Blockchain more relevant probably as a piece of technology than cryptocurrencies themselves for banks. And then the big topic of artificial intelligence. And all of these things are increasingly preoccupying bank boardrooms around the world. If you look at what the implications have been over the last decade and look at the market value of the top 20 firms in each category, you can look that banks were 80% of the total market cap of banking, payments, information providers, and fintechs in 2012, and they're now 50% of the market value of these companies. And that is a pretty dramatic change over a decade, and there's not a great deal of sign of it changing, though it is fair to say that the trend in investment is changing somewhat. What we can see is that these neobanks and fintechs have taken vast numbers of customers. That's particularly been true in a place like the UK, where we have, I use this word in the sort of traditional dictionary sense, we have promiscuous customers in the UK. And we have a lot of people who are very happy to try something new and don't exhibit a huge degree of loyalty to their traditional providers. And that's not just true in banking, actually. I mean, it's true frequently, you can find people will start a new beer, they launch it in the UK because people will try it. And it's the same as true in banking, that people like Revolut, Monzo have accelerated in their customer growth really rather rapidly. None of them have yet made any money. And some traditional bankers will say, well, there you are, this will never work. But then after 10 years, Amazon hadn't made any money. So I don't take too much comfort from the fact that they are not making any money at the moment. But then AI, finally, is the biggest challenge. I mean, a huge technology breakthrough. This quote from Andreessen Horowitz saying the potential side is hard to grasp, somewhere between all software and all human endeavors, which is a reasonably large range of possibilities, I think. If you look at it from a banking side, the one way we like to think of it is the way in which it impacts on digital wallets, on cryptocurrencies, on the way we use the cloud, indeed on all our customer-facing activity, these implications could be absolutely massive, I think. Some aspects of it are relatively easy to see. We can see that the implications for productivity could be massive. And a very recent report by Accenture tried to look industry by industry at the percentage of functions that could be replaced quickly by AI. And interestingly, they calculated that 54% of all functions in banks could be replicated by AI, and that was the largest of any industry sector. The good news is, of course, that there are huge potential productivity gains in a lot of customer-facing activity, but of course, that is also a threat to the business model. Because if you don't get ahead of it, then you could be facing competitors who have a massive productivity advantage over you. So this is something that we are rescuing with. Now, can we deal with it? Going back to my dinosaur analogy that Silicon Valley Bank kindly gave to me, the picture's pretty bleak, gentlemen. The world's climates are changing, the mammals are taking over, and we all have a brain about the size of a walnut. Is that the case for everyone in this room? Hands up whose brain is... Sorry, I don't think I should ask that question directly. But what I do know is that it is at the top of all our agendas. I shall be going back later this week to London, and next week we have our annual board strategy sessions like everybody does, and it'll all be AI. It will be absolutely entirely about that, about whether we can get ahead of this game, and one, take the advantages of it, two, try to ensure that we are appropriately competitive, and three, the defense part of it, because the opportunities for fraudsters to use AI are absolutely massive. The UK can proudly claim to be the banking fraud capital of the world. I'm not totally sure why this is, but it's something to do with the promiscuity of our customers. People are remarkably credulous, actually. And there's more fraud in banking system in the UK than anywhere else in the world. We can absolutely certify this. If you ask HSBC, who run operations everywhere, they say it's far worse in the UK than anywhere else. And this technology can allow people to replicate communications from their banks, and it will be very, very difficult. So I think as we think about the wonderful opportunities of AI, we also have to think about the defensive nature of it, and that's something that we're going to be spending quite a lot of time on. So I hope I've fulfilled the brief, which was an impossible one. I hope I've alarmed you, because that was my intention. And I think as we go on to discuss some of these implications, we'll probably alarm you even further. But I would say that I think that the fuss in the banking system, particularly in March or April of this year, has faded away. And touch wood, I don't think we're facing a systemic crisis as a result of the failures in the US and Europe. Thank you for your attention.